Welcome to the deep dive. Today we're getting into a market that's, well, full of contradictions. Addis Ababa real estate, looking specifically at 2024 through 2028. Our goal here is really to unpack this paradox. You've got huge growth potential. They're talking maybe 10% a year from urbanization, bumping right up against some serious systemic risks. Political, legal, financial, it's all in the mix.
Absolutely. And the tension is palpable. Just look at recent land auctions. It's pretty shocking, actually. Urban plots, just the lease rights, mind you, going for over 400,000 birr per square meter.
Wow, 400,000 per square meter.
Per square meter. It just shows the incredible premium put on simply securing land rights. That tells you investors see land access, that secure tenure, as the real bottleneck, maybe more than capital or materials.
Right, securing the right to build is the hard part. Okay, so let's zero in on the biggest shift. July 2024, what happened with the currency and what did that immediately do?
Yeah, that was the big one. They moved to a floating exchange rate, and this wasn't minor tweaking. We're talking to jump from, around 57 birr to the US dollar.
Yeah, about that.
To suddenly over 128 birr per dollar. A massive devaluation, almost overnight.
Okay, that's a huge shock locally. But for anyone holding dollars outside Ethiopia, suddenly everything looks incredibly cheap, right? High risk, sure, but potentially high reward.
Exactly. That's the bifurcation, the split it created. Ethiopian assets got cheaper for foreign capital, yes. But at the same time, construction costs shot up because so many materials have to be imported.
Ah, right. Imported materials priced in dollars?
Precisely. And locally, anyone with cash, with idle birr, basically ran towards real estate, trying to hedge against the hyperinflation they saw coming down the track.
Makes sense. So with that FX shock shaking things up, how did the government try to pull in foreign currencies specifically? You mentioned a new policy in 2025.
They did. They brought in new foreign property ownership rules. But the key thing to understand is that this is really about attracting hard currency, U.S. dollars mainly, not about, say, deregulating the market itself.
Okay, so strategic, not philosophical. What are the specifics? Is there a minimum buy-in?
There is a pretty significant one. Foreign individuals need to invest a minimum of 150,000 U.S. dollars to acquire a residential structure.
150K. And what can they not do? Are there restrictions?
Yes, very explicit ones. Foreign nationals can't get into commercial operations. So no buying land, developing, and flipping properties for profit. That's strictly off limits according to the rules.
Okay.
And critically, the fundamental structure hasn't changed. You buy the building, yes, but the land underneath, still state-owned. You get a 99-year leasehold, same as locals.
That 99-year leasehold, that's always the anchor, isn't it? So even with 150K, you don't own the land outright.
Yeah.
Is that 150K threshold high enough to deter pure speculation, though? Especially if, enforcement is maybe tricky?
Well, enforcement is always the big question mark, isn't it? But the rule itself is designed to signal no flippers wanted. Now, beyond the rules, there's the issue of asset stability itself.
You mean things like expropriation?
Exactly. The risk of asset expropriation for what they call corridor development projects is real. The government can, and sometimes does, prioritize its large-scale urban plans over individual property rights. That creates a layer of legal uncertainty.
Which sounds like it feeds right into another risk area, hidden costs, particularly around taxes. I heard they don't always use the market price for tax assessment.
That's correct. It's a non-transparent system. The government often uses its own predetermined fixed prices for assessing taxes like capital gains or VAT.
Wait, fixed prices. So say you sell a property for X amount, but the government's fixed price for that area is higher. Why? You pay tax on Y.
That's the risk. If your agreed market sale price is lower than the official government valuation, your tax bill is based on that higher government number.
Wow. That sounds like it could lead to some nasty surprises at closing. It must really discourage formal transactions, wouldn't it?
It definitely adds a huge amount of uncertainty. Many deals likely happen under the radar because of it. So, okay, given all these constraints, the leasehold, the FX volatility, the taxes, what's a viable strategy for a foreign investor who does meet that $150K threshold?
You'd have to find a way to shield yourself from the burr's volatility, wouldn't you? Earn income in hard currency.
Precisely. The most common approach, the path of least resistance really, is targeting the luxury residential market.
Yeah.
The prime areas like Bolé or Kazanchis.
Why there specifically?
Because that segment caters heavily to the diplomatic community, international NGOs, multinational HQs. These tenants typically pay rent in hard currency, in dollars.
Ah, I see. So you get dollar-denominated rental income.
Right. And the rental yields can be quite attractive. Estimates are often between 5% and maybe 10%. That effectively insulates your return from the local currency swings.
Okay, so wrapping this up, we have this market with huge underlying demand, driving prices for, say, an average apartment up to around $1,500 per square meter. That's comparable to parts of Europe.
It is surprisingly high parity in some segments.
But the real challenge isn't necessarily the price tag, it's navigating all this political and regulatory uncertainty we've been talking about. That's the core issue.
Absolutely. It's the unpredictability. And maybe that leads to a final question to think about. Given how expensive land leases are and how slow traditional construction can be, what happens if companies start introducing more efficient, maybe lower cost building technologies? Things like prefab construction.
Could that disrupt things?
It could potentially unlock supply for the mass market in a way speculation hasn't. Could that fundamentally shift the dynamics? It's something to watch.